Warren Buffett, the iconic investor and CEO of Berkshire Hathaway, is a household name synonymous with extraordinary wealth and investment acumen. Remarkably candid about his methods, Buffett educates us on how to accumulate wealth, even with modest funds. His advice: you don't need an array of stocks to achieve financial success. A few select investments can suffice, potentially even elevating you to Lamborghini status without a formal finance education. Buffett's strategy, known as value investing, involves identifying and investing in stocks that are overlooked or undervalued by the market, and holding onto them for the long term. This isn't a game of quick gains. We're talking about a commitment that spans years or even decades, with the aim of watching these investments steadily grow. Patience and persistence are key virtues in this approach, especially in times of market volatility or economic downturns, like the present recession warnings. Despite temptations to chase immediate riches or react hastily to market fluctuations, Buffett's method focuses on long-term stability and growth. His investment philosophy centers on buying and retaining stocks over extended periods, capitalizing on the power of compounding interest. He looks for companies whose market price doesn't reflect their true worth, based on their financial health, assets, and future earnings potential. By investing in such undervalued companies, Buffett positions himself to benefit when the market eventually recognizes their true value, leading to an appreciation in stock prices. Buffett's success isn't just a stroke of luck or random guessing. It's the result of thorough research, understanding of business potential, and a keen eye for risk assessment. He doesn't jump on every trending stock. Instead, he commits to companies he truly believes in after extensive analysis. Moreover, Buffett's approach to diversification is distinct. Unlike many investors who spread their investments across numerous stocks and sectors to mitigate risk, Buffett prefers a more concentrated portfolio. He believes that over-diversification can water down returns, leading to average outcomes. His strategy involves investing heavily in a limited number of companies he has strong confidence in, demonstrating a blend of strategic foresight and risk management. In summary, Warren Buffett's investment philosophy is a testament to the power of value investing, patient capital, and strategic selectivity. It's a lesson in looking beyond the immediate horizon, focusing on intrinsic value, and trusting in the long-term growth potential of carefully chosen investments. Warren Buffett's investment philosophy challenges conventional wisdom about diversification. In finance, he argues that diversification, often hailed as a prudent strategy, is primarily a safeguard against ignorance for those who are not confident in their ability to analyze and understand businesses. Holding a wide range of stocks is a reasonable approach to mitigate market risks. However, for someone knowledgeable in business valuation, excessive diversification is unnecessary and even counterproductive. Buffett emphasizes the importance of investing heavily in a few businesses that one thoroughly understands and believes in, rather than spreading investments thinly over many companies. He reasons that there are only a limited number of truly exceptional businesses that an individual can comprehend fully. Therefore, it makes little sense to invest in your 30th or 35th choice when you could be investing more in your top choice. The idea of owning a large number of stocks as a means to achieve average performance is, in Buffett's view, an admission of a lack of deep understanding of those businesses. On a personal note, Buffett mentions that he could be content owning just 3 of Berkshire Hathaway's businesses, underscoring his belief in the value of concentrated investments in high-quality businesses. He points out that many large fortunes have been built not through diversified portfolios but through substantial investments in a handful of outstanding companies. Buffett's approach suggests that a small number of excellent, well-understood businesses offer more security and potential for growth than a broad portfolio of average companies. This philosophy goes against much of what is traditionally taught in finance courses, which often advocate for widespread diversification to reduce risk. Buffett contends that true security and potential for significant growth lie in the deep understanding and careful selection of a few outstanding businesses, rather than in spreading investments across a vast array of average ones. Buffett's investment strategy, while it offers potentially high rewards, also carries its own set of risks. Concentrating investments in a few stocks means that a significant downturn in any one of these stocks can substantially impact the overall portfolio. However, for Buffett, the benefits of a focused portfolio surpass these risks. He believes in the power of investing heavily in a few carefully selected companies. Despite his personal approach, Buffett advises most investors, especially those who may not wish to dedicate time to in-depth stock analysis, to opt for low-cost index funds that track benchmarks like the S&P 500. These funds offer consistent, reliable returns averaging around 7% annually, which is considered a robust performance, especially compared to the volatile nature of markets like cryptocurrencies, where dramatic drops are not uncommon. To understand how Buffett applied his investment philosophy, let's consider three specific stocks that have been instrumental in his success: American Express, Coca-Cola, and Wells Fargo. These companies represent classic examples of Buffett's approach to investing in high-quality businesses with enduring value, each playing a significant role in the growth of his portfolio. In the 1960s, American Express was embroiled in the infamous salad oil scandal, which nearly devastated the entire futures and commodities markets. As a consequence, MX's stock price took a nosedive, creating a climate of panic among investors. While many retreated from American Express during this turmoil, Warren Buffett discerned a unique investment opportunity, identifying American Express as a fundamentally strong company with a solid competitive edge and a dedicated customer base. Buffett chose to look beyond the immediate scandal. Trusting his judgment, which has a proven track record of immense financial success, he made a bold move. In 1995, he invested a staggering $1.3 billion in American Express, a decision driven by his confidence in the inherent value of the company rather than the transient crisis it faced. This strategic investment paid off significantly. Over time, Buffett's stake in American Express burgeoned to an impressive $22.4 billion, exemplifying a 17-fold increase in value. Additionally, the investment yielded an estimated dividend rate of 23%. This remarkable success with American Express is a testament to the efficacy of Buffett's value investing approach. It showcases his exceptional ability to recognize and capitalize on the long-term potential of a company, affirming that patience and foresight can indeed lead to extraordinary gains. In 1988, amidst the aftermath of the Black Monday crash, when Coca-Cola was struggling with devalued shares and lower popularity, Warren Buffett recognized the latent potential in this iconic brand. Making a strategic move, he invested $1.3 billion in Coca-Cola, securing a 6% ownership stake by 1994. This foresight paid off spectacularly. Today, Coca-Cola stands as a globally recognized brand, and Buffett's stake, which has increased to about 9%, is valued at an astounding $24 billion. Additionally, he has reaped dividends of approximately $10.2 billion, a remarkable 54% annual rate. Similarly, in 1989, Buffett turned his attention to Wells Fargo. Despite its modest market price at the time, he saw the bank's robust management and potential for growth. His initial investment of $290 million for a 9.7% stake, which expanded to 13.3% by 1990 due to ongoing investments, proved to be another astute decision. During the housing crisis, Wells Fargo emerged as one of the world's largest banks, and Buffett's investment flourished, reaching a peak share value of $12.7 billion in 2016, with a market value of $22.1 billion. However, over time, amid corporate controversies and ethical concerns, Buffett decided to sever ties with Wells Fargo in early 2022, selling most of his stake but still garnering billions in capital gains and dividends from nearly 3 decades of holding. These investments align perfectly with Buffett's philosophy because they represented high-quality companies with strong fundamentals, temporarily undervalued by the market. This allowed Buffett to capitalize on these opportunities for long-term gains. Today, Coca-Cola and American Express are esteemed as blue-chip stocks, with Coke being one of the world's most valuable brands. While Wells Fargo has recently faced challenges, it remains a significant entity in the banking sector. Investing, as per Buffett's principles, requires a focus on long-term gains. Identifying high-quality companies and understanding the underlying business fundamentals, avoiding frequent trading and not getting swayed by short-term market fluctuations are key. Buffett, influenced by Charlie Munger, shifted from a purely quantitative approach to prioritizing the intrinsic quality of businesses, recognizing that this is what ultimately dictates long-term success. This strategy has become a blueprint for numerous investors aiming to replicate Buffett's extraordinary success. 3. Embrace value investing. Buffett is renowned as a value investor, seeking out stocks that are undervalued by the market. His strategy involves finding companies with robust fundamentals but whose shares are priced below their intrinsic value. This approach offers a safety margin and the prospect of substantial gains when the market eventually adjusts to the company's true worth. 4. Maintain a concentrated portfolio. Known for his concentrated portfolio, Buffett focuses on a select few stocks in which he has the highest confidence. While this method entails risks, it also holds the potential for considerable returns. However, it's crucial to conduct in-depth research and analysis to ensure each investment is a high-quality company with solid fundamentals. Buffett doesn't fully endorse diversification. It acts as a safety net for some investors. It's important to remember that risk tolerance, investing skills, and personal financial situations vary among investors. Investing is not a guaranteed success, but adhering to these principles and maintaining a focus on long-term objectives can enhance the likelihood of investment triumph, as evidenced by the Oracle of Omaha. For those with an adventurous spirit, adopting Buffett's strategies requires diligent research and a realistic expectation. Becoming a billionaire or even a millionaire doesn't happen overnight. It demands time, patience, and considerable effort. Beginners should start with the basics of investing, learn to interpret financial statements, and research companies thoroughly. It's also vital to invest within your circle of competence, as being a jack of all trades often leads to mastery in none. While Buffett's investment philosophy is celebrated for its simplicity and effectiveness, he suggests that most people are better off with an S&P 500 index fund. This option offers a diversified portfolio covering a wide range of industries, ideal for investors seeking a share in the national economic growth over the long term. However, for those willing to invest time and effort in researching individual companies, targeting a select few stocks is reasonable. This requires a deep understanding of the company's financials, industry dynamics, and competitive landscape. A concentrated portfolio carries risks. A significant drop in one stock can lead to substantial losses. Conversely, if the chosen companies perform as expected, the rewards can be significant. As Buffett's own track record demonstrates, ultimately, the choice between focusing on a few key stocks or investing in a diversified portfolio like the S&P 500 is dictated by individual risk tolerance, personal circumstances, and investment objectives.